Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Maze Therapeutics Inc. Annual Report. Maze Therapeutics Inc. is a clinical-stage biopharmaceutical company that specializes in developing small molecule precision medicines for various diseases. The company's lead programs include MZ-829, an oral inhibitor of apoLone, which is currently in phase II clinical trial for the treatment of apoLone kidney disease. Another key program is MZ-782, an oral inhibitor of SLC6-ananetine, which is in phase I clinical trial for chronic kidney disease. In addition to these programs, Maze Therapeutics also offers a clinical program for the treatment of Pompe disease through its MZ-EON initiative. This comprehensive approach demonstrates the company's commitment to addressing complex diseases and improving patient outcomes. With its focus on precision medicine and innovative treatments, Maze Therapeutics is poised to make a significant impact in the field of biopharmaceuticals. The company's pipeline includes several key areas of focus: renal disease treatment through MZ-829 and MZ-782, cardiovascular and metabolic disease treatment, and obesity treatment. These diverse programs reflect Maze Therapeutics' dedication to addressing a range of health issues affecting millions of people worldwide. Maze Therapeutics, Inc., market capitalization of $2 billion, is materially smaller than most of its industry peers of roughly $2 billion. Maze Therapeutics, Inc. trades at a higher price-to-book ratio of 4.44 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 229% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the one hand, revenue growth is primarily driven by upfront payments from licensing agreements, milestone payments, royalties on future net sales, commercial sales of therapeutic candidates, and license revenue. These sources contribute significantly to the company's revenue stream. On the other hand, revenue decline can be attributed to the expiration of license agreements, decrease in license revenue, and operating losses. The expiration of license agreements marks a significant loss of revenue, as these agreements often provide substantial upfront payments and milestone payments. Furthermore, a decrease in license revenue also contributes to revenue decline, highlighting the importance of maintaining strong licensing agreements. Operating losses are another critical factor that can lead to revenue decline. Companies with a history of operating losses may struggle to generate sufficient revenue to sustain their operations, ultimately leading to a decline in overall revenue. By understanding these primary drivers of revenue growth and decline, companies can make informed decisions to mitigate risks and capitalize on opportunities for growth. The net income of the company underwent a significant change between 2024 and 2025. Initially, the company reported an income of $52.2 million in 2024, but this turned into a loss of $131.1 million in 2025. This decline was attributed to increased scrutiny by Congress of the FDA's approval process, potential delays or prevention of marketing approval, and increased regulatory requirements and penalties. The profit margins also experienced a significant change during this period. Initially expected to remain negative due to significant operating losses, the company's profit margins were implied to be positive in 2024 but turned negative in 2025. This decrease was attributed to downward pressure on prices from state and federal healthcare reform measures, potential for more stringent product labeling and post-marketing testing requirements, and technical and legal risks associated with using open-source software. The reasons behind the decline in net income and profit margins are multifaceted. Increased regulatory scrutiny and potential delays or prevention of marketing approval led to a significant decrease in net income. Similarly, downward pressure on prices from healthcare reform measures and stringent product labeling and post-marketing testing requirements contributed to the decline in profit margins. The company's reliance on open-source software also introduced technical and legal risks that further impacted its profitability. In conclusion, the net income and profit margins of the company underwent significant changes between 2024 and 2025. While the company reported an income in 2024, it turned into a loss in 2025 due to increased regulatory scrutiny and potential delays or prevention of marketing approval. The decline in profit margins was attributed to downward pressure on prices from healthcare reform measures and stringent product labeling and post-marketing testing requirements. The company's debt level and interest expenses have undergone some changes over the past year. Initially, there was an increase in total debt from $43,638 in 2024 to $42,161 in 2025, which is a decrease rather than an increase. However, this trend was reversed with the Hercules loan agreement, where the debt level increased by up to $200 million. In terms of interest expenses, there has been no significant change indicated on most pages. The total interest expenses for 2025 are included within the change in fair value of convertible promissory notes, which was $0. Additionally, the interest expense on convertible promissory notes is included with changes in fair value, but no specific amount is provided. However, it's worth noting that the company accrues interest at an annual rate determined by reference to the prime rate, with floors ranging from 7.95% to 9.25%. Management's outlook for the company is cautious and focused on long-term growth. They expect to incur significant operating losses due to research and development costs, which will continue to increase substantially in the foreseeable future. To achieve profitability, the company needs to successfully commercialize or partner its therapeutic candidates. The management acknowledges that substantial additional capital will be required to fund operations for the foreseeable future. This highlights the company's reliance on external funding sources to support its growth plans. Despite this, they are confident that their cash reserves will be sufficient to cover at least 1 year of operations. Management is also concerned about protecting the company's intellectual property and mitigating cybersecurity risks. They have implemented measures to address these concerns, including a comprehensive risk management program and technical safeguards. Overall, the company's strategy appears to be centered around developing new therapeutic candidates using its Compass platform, while navigating the challenges associated with significant research and development expenses. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has entered into agreements that provide access to valuable resources and expertise. The Neurocrine license agreement grants a license to the ADX Entwo discovery program, while the consortium agreement with University of Helsinki allows for collaborative pre-competitive research. Additionally, the Genes and Health Industry Consortium agreement with Queen Mary University provides access to genetic and paired clinical data. These acquisitions are expected to enhance the company's research capabilities and provide new insights into potential treatments. On the other hand, the company has also made divestitures, which involve transferring ownership of certain programs to other companies. The ADX Entwo program was sold to Neurocrine Biosciences, Inc., while the UNC13A program was transferred to Trace Neuroscience, Inc. Furthermore, the ANKT L7 program was spun out through a company called Broadwing. Overall, these strategic moves demonstrate the company's commitment to advancing its research and development efforts while also streamlining its operations. By acquiring new resources and expertise and divesting non-core programs, the company is positioning itself for future growth and success. The company's financial policies have been a subject of interest for investors and analysts alike. While one aspect of its policy is notable, another is less so. The company has not paid dividends to its shareholders, indicating that it prefers to retain earnings within the business. On the other hand, the company has engaged in share buybacks as part of its capital management strategy. Specifically, it purchased 110,644 shares under the 2025 Employee Stock Purchase Plan, ESPP. This move suggests that the company is committed to returning value to shareholders through alternative means. Concerns about inventory buildup or supply chain disruption are evident in various aspects of the industry. One major concern is the potential for product supply disruptions due to changes in U.S.-China policies, political unrest, or unstable economic conditions in China. This could impede, delay, or increase the cost of manufacturing. Supply chain disruptions caused by macroeconomic events and conditions may also negatively impact the company's cost of materials and production processes. Furthermore, global affairs such as conflicts overseas can lead to potential interruptions or delays. Additionally, geopolitical actions can result in staffing shortages, business and economic disruptions, and supply chain disruptions. The possibility of product supply disruption is not limited to external factors. Internal issues such as economic downturn affecting suppliers and partners can also cause development or supply disruption. Addressing these concerns requires proactive measures to mitigate the risks associated with inventory buildup and supply chain disruption. That concludes the financial summary for Maze Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.